Okay, so this comprehensive video will show you the 7 areas you might want to think about investing your money when you get paid. However, if you follow through and carry out all 7 of these distinct phases, you can find yourself in a much better position financially than you were previously, and that is our main objective. This channel supports people's financial development so they can establish a better financial future by helping them invest, save, and earn more money. As a result, if you're new to the channel and want to learn more, you should think about clicking the subscribe button and the bell notification icon so that you may be notified of future videos like this one. Let's start! It's crucial to first realize why there are so many people that earn $50,000, $60,000, or $75,000 a year or more. Why do they still face financial difficulties? Why do they still have such high debt amounts? Are they being marginalized by the economy? Are we paying too much in taxes? What exactly is wrong? And while each of those aspects may have an impact on a person's capacity to pay their debts, the figure is ultimately what matters. The fact that majority of people lack financial literacy is one contributing reason. We don't cover it in our classrooms. Most of the time, our parents don't teach us about it because some of them are in the same economic state that their children and grandchildren would eventually find themselves in, making it effectively a trickle-down system. Hopefully, this video will be some of use to you right now. It turns out that because they are currently in such a financial hole in most of their life, about 40% of Americans can't afford to pay a $400 emergency bill. Let's discuss where you should store your money as soon as you receive your pay, okay? Your retirement fund is the first thing we're talking about here because it happens before you are paid. Now, if you're in America, around 65% of this channel's viewers are American citizens. You might benefit from maybe a 401k plan that your employer might provide. There are other choices if you don't have 401k plans, but withdrawing money out of a plan like a 401k before you ever receive your paycheck might undoubtedly help you build the future you're searching for. The only thing worse than dying is running out of money before you, which has been said to be one of the worst things in the world. I'm not sure how totally true this is, but it does have some basis in reality. As I already stated, I would much prefer to be alive than dead. However, it is terrible to consider the possibility of going bankrupt before dying. It occurs to everybody, even if you're in your 20s and think that saving for retirement is pointless because you won't be retiring for another 40 years. You don't want it to happen to you, so now is the ideal time to start. Therefore, saving 5 to 15% of your income before you can even see your paycheck in a plan, like in a 401k, is something you might want to think about, particularly if your company is willing to match that chance. Just remember that I don't mind talking to financial advisors and that you should be aware that each financial choice you make carries some risk. You must therefore make your own financial judgments regarding what to do with this, because there are risks associated with each investment you make. However, many people do take benefit of this concept. Regrettably, some younger people, particularly those who are just beginning their careers, choose not to participate in 401k plans. They reject some of these pre-tax retirement assets that they are able to invest in ultimately cause them great harm. Thus, before even receiving your paycheck, this is the very first thing you should think about doing. Set it up with your employer. If not, there are options, particularly if you live outside of the United States. Your government may have something that's very similar to a 401k plan, such as a way to pay taxes before receiving a paycheck or a way to have money deducted from your paycheck before it is deposited into a retirement account or investment fund that you can join. Let's discuss about the next one, which is the money that enters our checking account after being deducted for your retirement fund. So, as I mentioned earlier, our paycheck is deposited into our bank account. This will serve as our primary point of contact for everything that occurs. As far as 90% of people care, their savings are simply their bank account, which they use to pay for everything from their credit cards to everything else. They don't have anything more, but what I'm going to demonstrate here is that there will be two distinct things taking money out of your checking account, and this is what's going to be crucial. Having only one bank account could be a mistake. You should think about having many accounts for a variety of situations. You can have automated transactions into various bank accounts. So, the second step is to deposit the money into your checking account, which can serve as your central hub for all of your activities. Some individuals might not receive automated transfers from their employers into their accounts. It's usually going to be best to actually get funds directly deposited into your account, since then you can instantly withdraw money. Regardless of whether you get paid in cash or in a physical paycheck, you can set it up so that you don't need to physically visit the bank to hand them a check to cash or go inside with cash to try to deposit it into the bank. Doing so just takes too much time and is frequently not worthwhile. If you can arrange for that with your company, it's best to just have money immediately transferred into your account. The next one is quite significant. In essence, if you're using this to cover your basic needs. When I say necessities, I mean the very minimum requirements to keep you off the streets and to maintain your livelihood. We're not talking about your Netflix subscription. We're not talking whether you want to get your nephew an iPhone for Christmas. We're not talking anything similar here. We will focus on people's fundamental needs here like food, shelter, transportation, healthcare and utilities, so you don't have to think about losing a place to live or electricity being cut off. This should depend on where you live, how many children you have, and your current circumstances. There shouldn't be too much money involved with this. We're discussing the fundamentals. Rent and utilities are the topic at hand. Paying those is crucial to maintaining your livelihood. You need to be able to distinguish between your needs and wants at this stage, nothing else. Needs and wants are very critical, and many people struggle to differentiate between the two. Therefore, you should think about what you need to survive and what you want. Could you try to find an alternative to reduce the cost of your food without having to buy McDonald's? Never cut corners when it comes to your healthcare. I've noticed that some individuals miss out on things like health insurance and medical visits in an effort to save money, but in the long run, this might be highly detrimental to you. Thus, be aware of your needs and meet them, but do nothing else. Additionally, you should think about the minimum credit card payments. We'll discuss about it later. So let's discuss your emergency fund. Everyone should have an emergency fund, regardless of whether they have $1 million in their bank account or a negative $100,000. Building an emergency fund is going to be among the initial stages to somewhat relieving any current financial stress you may be experiencing. This will be an important step. It can be put at $2,500, but it may eventually increase to $500, $1,000, or $10,000. It's excellent to start building this up, and a fantastic technique for doing so is to simply save aside $10 or $20 or $40 from each paycheck and deposit it into a distinct emergency fund that is highly accessible. Since this is for cases where it is truly an emergency, you need it to be easily available. It would be an emergency if you needed to have a tooth pulled out but didn't have any money on you because you were in excruciating agony and couldn't concentrate on anything else. If your brakes fail and you have to use it to get to work, it would also be an emergency but nothing else. We're not referring about going on vacation, buying someone a gift for the holidays, or just feeling like eating out. This is only to be used in emergency situations. You want this to be fluid and you want it to be simple to get your hands on. And as such, it would probably be advisable to keep it somewhere in a completely separate checking account or savings account so that you can readily access it. You might also think about keeping it in cash, but I wouldn't recommend having $2,500 on hand. But like I mentioned, if you have a family, you can try with a smaller sum of money, say $500 or $1,000, and gradually increase it. Think about increasing this a little bit, perhaps to $5,000, just in case. Perhaps you have the money on hand to cover some medical costs. And as I mentioned, having an emergency fund is crucial even if you are in debt, as you will run out of money when you reach zero. Having this will be a huge benefit because every time there is a small expense, you might have to start taking on more debt to pay it off. So, the fifth item on the list is paying off your debt. Now that you have established that emergency fund and are beginning to stabilize financially, you should think about how to truly pay off your debt. There are many ways to achieve this, but there are really just two main approaches to paying off your debt, based on your personality and the amount of debt you have. The debt avalanche method is one of them, and the debt snowball method is another. You might want to think about adopting the debt snowball method if you're one of the many folks who are really struggling to make ends meet and have a lot of debt but find it difficult to stay motivated to pay it off. Let's imagine you have 5 distinct sorts of debt: a home mortgage, student loans, a personal loan, possibly credit cards, and a car loan. This is basically the debt snowball strategy in action. The debt snowball strategy requires you to pay off the debt with the lowest amount first, regardless of interest rate. For example, if your auto loan has only $1,600 remaining, you would pay it off first. And afterwards, let's say that your personal loan has the second lowest amount and balance remaining on it. So you handle that one, and then you go down to the list addressing the one with the lowest amount of money that you owe, essentially getting rid of those various debts until you have relatively fewer types of debt. Once you start paying off those various debts, you will undoubtedly feel better because it can be very challenging to maintain a debt repayment schedule when you have to pay off 5, 6, or 7 different debts and a multitude of expenses at the same time. But I want to warn you about something, because I have family and friends who will take out loans, student loans, auto loans, mortgages even, and then when they eventually find themselves unable to pay them back or unwilling to do so, they try to avoid doing so. It's similar to when you were in school and you had a project that you knew kept weighing heavily on whenever you were doing something. Like maybe you're at a party and you're just starting to think about this project, or there's paper that you had to write. It's just always at the back of your mind, inching on you because you know that you're procrastinating. People avoid taking out loans because they do that. Perhaps they will stop answering debt collectors' calls, stop checking the mail, and try to just not look at the fact that they are overdue for payment on a number of different loans and have defaulted on those debts. However, it is among the worst circumstances you can be in, since you need to face it head-on, because once you do, you'll feel much better once you begin paying off different kinds of debt. You will save more money with the debt avalanche strategy, since it mathematically and rationally makes more sense. Nonetheless, it relies on your personality as well as how much you can truly concentrate on this without losing some of that reasoning. According to the debt avalanche technique, if you have 5 different types of debt, you should focus on the ones with the highest interest rates rather than starting with the lowest balance. So let's assume you owe $20,000 in credit card debt. This is a significant sum compared to your other debts, which might include your car payment of $1,600 and other personal loans, but not the $20,000 in credit card debt. It is a debt avalanche strategy to start with the highest interest rate because credit cards are likely to have the highest interest rate. The APR for certain cards may be closer to or higher than 20%. Here, you're carrying out the same actions, but you're attacking the high interest rates first. You're also continuing to pay off one bill at a time and making the minimum payments on all other debts. You would not want to cancel on them or skip those minimum payments because doing so can seriously damage your credit score, cost you late payment fees, and just be a pain in the ass. Saving up at least 4 to 8 months worth of wages will be step number 6, which is what I would call arguably the most fun part of the entire process. In order to keep this example relevant to over a year's worth of payroll, allow me to tell you a quick story today. So, Bill Gates discovered that he struggled to win over investors when he launched Microsoft. He realized that investors might put a lot of pressure on him in particular circumstances. So he saved up enough money. He sought to have enough money in Microsoft to cover the annual salaries of all of his staff. If the businesses didn't make any money, he had enough cash on hand to pay all of his people for an entire year. The reason for this is because he understood there would be times when they would release a product that wasn't as good as they hoped it would be and might not be making as much money as he had anticipated, but he would still be able to pay his staff. I learned about this and came to the realization that even if the economy now is doing well, if you have a work and you take it for granted, things could turn worse. Remember the recession we saw a decade ago? How many people lost their jobs? The unemployment rate was close to 10%. Particularly if you're an entrepreneur, if you work for yourself, you must be aware that there may be times when things don't go as planned and your income may decline drastically. Therefore, you should save some funds rather than just a standard bank account where you are literally making losses. I like to use something like an online savings account because we're talking about something that will stay up with inflation by using a regular bank. You can obtain them for more than 2% interest, which will practically keep up with inflation. What I enjoy about this is that it's something that is extremely steady. You shouldn't invest too much money in this at this stage. You make your financial choices, thus you can decide whether to do this or not, which is true in many situations. But as you are aware, this does happen occasionally. People occasionally experience financial hardship, so possessing this will give you great peace of mind knowing that even if you lose your job tomorrow, you can make ends meet for 6 months before looking for a new one. So this is something I like to do. And you might also think about investing in CDs or money market accounts. In contrast to CDs, which lock your money up for a set period of time, I prefer investing in stable investments that keep pace with inflation. You may also think about investing this in stock market bonds or other types of assets, but I prefer this because it is more stable and predictable. Let's talk about the final topic here, investing. Right now, if you have money in a bank account earning you 2.5% interest, that is probably not going to make you wealthy. This is how you can actually make it work for you in number 6. Although holding on to something will be great, investing has the potential to make you wealthy. We're talking about real estate, stocks, bonds, and other sorts of investments, even potentially riskier ones like cryptocurrency. Whatever you're interested in and knowledgeable about, you can think about investing in. However, in this case, you can make your money work for you. This is the 7th step. Many people wonder if they should invest first or pay their debt first, but you can accomplish some of those things simultaneously, especially if your debt has a low interest rate. You could pay off your debts at the same time as investing if you have student loans that are 4% or a 30-year mortgage with a 4 or 5% interest rate. However, if you have significant debts, such as credit card debt or debt with interest rates that will be higher than 9, 10, or 11%, you may want to think about paying them off almost completely before you begin investing your money, because the average growth on the stock market is between 7 and 10%. You should keep in mind that it certainly fluctuates quite a bit. The money you have left over after completing these 7 steps can then be used on travel, vacations, TVs, and other forms of entertainment, but only after completing all 7 of those steps. Before you can even begin doing all these other stuff that you wish to accomplish, you must first pay yourself. And I believe that some people experience this issue with their money management. This is the reason why those who earn $80,000 a year are poor. It's a result of the fact that they do not follow these 7 steps. Rather, all of their cash flow enters their bank account. They aren't monitoring it, they don't have a budget, they don't conduct themselves like a business, and instead spend the majority of their money on leisure activities, travel, and other non-essentials, which causes them to suffer greatly. Hence, pay yourself first. If you invest money, you can find that your financial situation for the long term is substantially better. If you're having trouble actually saving money or moving on to step number 7, it's possible that you're one of those people who only manages to move on to steps 3, 4, or 5 before running out of money. They lack resources to invest. They don't have enough money to cover the salary or even the next 6 months' payroll. So what should you do now? You might think about taking up a side job, choosing a side business, and finding a way to get some additional money in your free time so that you can invest it all or use it as a 6-month paycheck for yourself. Please do share this with someone you believe would learn from it if you found it helpful. Thank you for watching. We'll see everyone again soon, and I sincerely appreciate your support on this channel. I wish you everyone a good day.